InnoVen.
Hey, welcome to Shunya One, episode 38. So today we're going to have a very interesting conversation about venture debt, working with VCs, and of course some interesting innovation coming up in the healthcare space. All of this with Suhani, who's going to join us on the show today. Before that, Amit, how's it going? What's happening on our Slack channel?
It's been pretty good, man. The Slack channel is it's been a little less active this week. I mean, like, guys, come on, let's participate. Let's have some discussions over here. I mean, like, and Slack is one place. I mean, like, we are continuing to get feedback on Twitter. But come on, I mean, we'd like to use the Slack channel a little bit more. So come on, guys, put some stuff in here.
Yep. We've got some, we had a very interesting episode last week with Samida and some lot of inside gossip on the VC space and startup space. So we're hoping to get a lot more speakers like this with us and guests on the show. So look forward to hearing your inputs. Let us know what kind of things you want to listen to, what kind of people you want to hear from. And we'll love to keep doing this.
Yep, absolutely. Cool.
All right, onward with the show today.
So today we have Suhani Chhaparwal, the ex-associate director at InnoVen Capital, and before this Silicon Valley Bank. I think you've been one of the folks to sort of see the start of venture debt in India, and now maybe future entrepreneur. So thanks for coming to the show, Suhani.
Really excited. I'm so glad we're doing this now.
Yes, finally.
Also, I have a lot of time on my hands now.
Oh, no. I think like most folks in VC who leave VC, what do they do? In fact, that's also an interesting question. I know a lot of founders, when they're ex-founders, they get jobs. Sometimes in venture capital.
Yeah.
And,
or anybody who give you a paycheck.
Yeah, pretty much, because you've
if you're an ex-founder, you need a paycheck.
Unless you've had an exit.
Yeah.
Then you become a Facebook bot.
I think I can guess who you're talking about. Not getting there, but I guess VCs, post-VC, two rungs, right? I think the partners just go on to raise their own funds if they've had some luck, or if they still have the energy to go do it, like for one whole 10-year piece and then another after. The lower rung, post-MBA, I guess, it's tricky, you know. I think it's definitely not easy to become an entrepreneur right out of VC. I wouldn't take it for granted that you understand a space or you have a network that you can leverage to really start solving problems. It is so different from working in a small team versus working in a large team and actually making those decisions without guidance, as opposed to just guiding in a boardroom.
Right.
So having said that, and we haven't had a lot of people leave VC firms, right? I think India is still young at that, and we don't have a whole crop that's gone out and done something. Or
the life is so good, they just want to stay on.
Just want to stay on.
But tell us about how your journey's been and what you've seen.
So I started in 2012 and I started my career at SPB. What sold me, of course, was just it's so interesting to be around conversations on why people are buying from Flipkart but not Snapdeal, and would Yatra do well because it's a number 2, and just everything that you really interact with in your daily life, you're working around. So that just made work so fun. So that was an entry point that really sold me, like in the first bit of my journey itself. Having said that, I think it's a job that does not feel like one, because not only are you working with interesting people all the time, a lot of these people end up becoming your friends and you're socializing with them and you're constantly brainstorming, etc. And it becomes a group. And that also keeps people going on and keeps them motivated. The third thing, and more specific to the organizations that I've been a part of, is just how fantastic it was to launch a new product. It was, to some extent, a startup itself. Silicon Valley Bank in India was launching venture debt, a product that the country hadn't seen, a company that the country didn't know that much about. SVB is, of course, big in the US. It's one of the biggest technology banks, and definitely banks like half of all startups that come out of the US, and then London and Israel and China. In India, they started operations sometime in 2008. But backtracking on this, what venture debt is it's a co-investment model. We work with VCs to lend to their companies, their portfolio companies, which means the growth in venture debt is always reliant on how big the VC market is. 2008 to 2012, not that big. The check sizes were small, $2 million Series A's maybe. The VC funds themselves didn't have a track record. Maybe the team itself didn't have those kind of relationships where you're really starting to write checks basis that. And maybe at some point we'll get into why those relationships matter and how exactly is a deal structured and all of that. So when I started in 2012, it was still new and fresh and interesting. So it went from being a lot about business development, solving problems as they come, actually adapting the product to the market. So, for example, we used to have a lot of committees, etc., which were global. So we had US-based folks who were on our ICs and on our discussions, and they would just not understand how are we funding a jewelry company online, or that we have consumer brands here, like chips companies, I know Pratap Snacks, etc. If those got discussed in the committee, they wouldn't consider those as startups. These are businesses. And I think just going through that adaptation of what innovation meant in India, it was probably more services or more simple problems being solved through simple adaptations and not solid tech, IP, etc. That made maybe the daily parts of the job also more interesting, because at every point of time you find yourself in a spot where you're simplifying things, you're yourself understanding how the market is behaving. So that was back in the day. So 2012 and 13 was a lot about that. Somewhere around 14, 15 is where I think we started really catching steam. Around the same time when the VC market itself started getting super hot. At that point, we were just looking to grow as fast as we could, which is where the startup speak comes in, right? We ourselves actually went through a transition where SVB was bought out by Temasek and United Overseas Bank, and that meant we made projections.
Wow. Yeah.
I will not tell you if you met them or not, but so I think that's the entrepreneurial side of things. And on the VC side of things, we were actually seeing the ringside view of how VC was evolving and how should we evolve with that. So when people are chasing home services, or if they're chasing hyperlocal delivery, how does a venture debt shop think about that? And at this point, we were on our own because we didn't have the SVB systems and their know-how that we could sort of more constantly lend to. Here we had to, as a team, make our own decisions and think about what was right or not from only the fundamentals that we'd learned before. Also, around 2015, we started our Southeast Asia business. We brought that online. China just started recently as well. So a lot of outlook change happened from US, India to a more Eastern platform that we were trying to build together. And we did realize that there was so much that we could lend to each other as a platform. All these Chinese VCs or Southeast Asian VCs looking into India, like Jungle or Shunya, and a lot of Indian companies that were large enough that the Southeast Asian markets were aping them in some ways. So it's just this huge melting pot. And I think the number one thing about any venture debt shop is that the intelligence that you see may be slightly larger than it's wider than what a VC firm sees.
Okay.
So, for example, a venture debt organization typically does not take strategic positions or both seats. And what that means is that we can work with competing companies. When we can work with competing companies, we can work with the number one and the number two, and from the learnings of the two, we are better equipped to understand whether a number three would make sense or not.
In a sense, in a lot of ways, you are a smarter bank.
Yeah.
Right? You're a bank which is...
Yeah, more nimble bank.
And more nimble and more focused on, again, the VC...
early stage businesses. So I think,
not
I think that's a
mature.
big difference. No, because the key difference, I think, from what I understand is banks for lending, for borrowing with banks, I mean, like collateral and all that kind of stuff is there, right? Whereas over here, this is more along the venture model somewhat.
Of course, of course. I mean, the alignment is a long venture, but...
So on a spectrum from bank to a VC, and these are all forms of capital, right? And on that, this would definitely lie closer to the VC model, because ultimately, what are we lending on the basis of? It's, like you said, not collateral, definitely not track record, but and absolutely not personal wealth and all of that. So that would never work. I mean, asking an entrepreneur to not only put their sort of lifeblood and sweat, but also their family jewels is asking for too much. So our model is similar to VC in that sense, that we need the companies to do well. We need enterprise value to be built. We need it to be attractive enough that the probability of success that you will raise the next round of financing, which is ultimately what will pay off the debt, that all comes together. And isn't that what a VC is seeing? A Series A investor needs to see a Series B come together. So that journey is definitely closer to VC.
Right. So when we were talking earlier, you were kind of outlining, the mechanics of how some of this kind of works. I think that would be kind of helpful to people to understand. So if you could kind of give a little bit more of a primer on, the way this actually kind of flows through, the way a deal would typically go through.
So venture debt, like I was saying a little bit earlier, is a co-investment model. We're providing alternative form of financing, which is returnable in the sense that it is debt. So we're not...
You need to pay it back.
Yes. Simply put, we need our money back, and along with that, we need some interest. But that's the basis. But the kind of companies we reach out to are only startup companies that are backed by venture capital investors. Why the VC is important is because we don't take strategic positions in these companies. So we rely on the VC to be our eyes and ears and help us evolve on what their thesis is and what the outlook across the market is. And also because one of the underwriting anchors is the fact that the VC is supportive, and we rely on the VC. Right. So, for example, there are funds we may have done multiple deals with, and that helps us because, one, it makes us form a relationship with the individual itself. Mm-hmm. Second, we start understanding what's a VC's pattern, how supportive are they, because while there are no guarantees on the table, of course, we ourselves have some judgment on what is the partnership between the VC and the company like. Will there be more support forthcoming? Is there wherewithal to provide more support? For example, at angel or seed stage, that becomes a challenge, which is why venture debt for extremely early stage is a problem. Right. Compared to working with institutional funds where we have a sense of how they operate. Right. Which is why the VC is important. Apart from that, the outlook on how the deal happens in itself is once we get to know a company and we're evaluating an opportunity, we would look at the basics, of course, the hygiene, the finances, etc., the cash in some ways, because similar to how a VC is looking at it, the cash flows are important. We need to see how much money you have and how long will that last, and where's the next round of cash going to come from. Mm-hmm. Having said that, a bank doesn't do it. So when we compare it to a bank needs 3-year sort of audited financials and Lord knows what. And that just does not work with startups. They are constantly evolving, definitely pivoting, and they themselves are figuring things out along the go. And that's a big reason why, at least I personally believe, venture debt needs to be a specialized business. You can't really be a bank and also develop this expertise and be constantly focused on understanding this market. Mm-hmm. So when we start evaluating the opportunity, we look for some of those hygienic signals. We sort of start speaking with the VC investors, trying to get a sense of the founder himself, because a lot of credit in the underlying is intent to pay back, right? You have cash, things are okay. But what happens when you're in a position when you need to decide? So some of those checks and balances will come into play. A venture debt deal on the specs of it is typically maybe 15 to 20% of the cash that you may have in the bank. Alluding to the point I made earlier, maybe it's
cash tough. You have from your VC invest in the same round as well.
Possibly. So for early stage companies, it would be VC money. For maybe a Series D or beyond, you also have operating cash flows. Right. So we're marrying the two together. I was saying on the early stage, say pre-Series A, it becomes tough. If you're doing 5 crores, for me to do a 1 crore check, that's still not enough. It's not enough skin in the game for an investor for us to take comfort that they're going to follow on. Maybe even for the founder. It's at 5 crores, it's probably still a small enough company and it's at the experimental stage. So those fundamentals maybe start getting clearer at a Series A, slightly better at Series B, so on and so forth. So those kind of qualitative judgments happen at that stage.
Right.
Yeah, in fact, while venture debt as an instrument, or rather as a form of capital, is something more aligned with VCs, like you just said, I may know a little bit of this, but correct me if I'm wrong. only look at the capital return as a pure interest return. You're not necessarily always taking equity positions on your deals.
Interesting question, because we don't get that a lot. We do need to make the interest. That's the bread and butter. The way the model works, though, is, as you can imagine, there is mortality in our portfolio as well, just as in a VC's portfolio. And even though we're slightly better off on adverse selections because we're only working with a certain rung of companies, we're trying to make good companies better and not necessarily be the first check on the table. Despite that, of course, there are companies that wouldn't work out. And the way we make up for those losses is by making supernormal returns on some companies. So venture debt is actually a structured financing instrument where along with an interest, we do have an option to make some extraordinary returns if there is an outcome. So this would work similar to what warrants are called as in the US, and that helps us create some liquidity when there is a liquidity outcome for every other party. Like if there is an acquisition or if there is an IPO, at that point, think of it as we're back-ending our returns while we're taking the risk up front. We think the companies can possibly pay somewhere around, say, 13-15% kind of interest rates. And beyond that, the risk may be worth 20%. We're just not charging that additional 5-7% now. We're keeping that as an option out. If you do well, we'll take our returns. If you don't, we won't.
Yeah, but I mean, you only really owe the money back. Like the founder or the company actually just owes the money plus interest back.
Yeah.
In all normal scenarios.
Unless the liquidity happens.
Exactly. And what kind of terms typically, or is it also linked with the next round of funding?
On the equity option, it's really a deal structured similar to how an equity does. So things that would make a difference while structuring around would be, is this a correct valuation? Has it been priced recently? A venture debt shop does not really price, which means if we're too far away from a VC round that happened, then we need to start thinking about, is that the fair price? And since we wouldn't discover our own, then maybe we're reliant on actually coming up with something that makes more sense. But that part, I would say, is slightly more negotiable and depends on case-to-case basis. Apart from that, the terms are fairly standard. There's fixed coupon, which is the interest rate. The tenor is what, of course, gets played around with a little bit. Depends on the stage of the company, what kind of runway you're looking at. And along with that, what kind of breather can we give you? So companies typically define this as moratorium. So you get a 3 to 6 month breather. You've just raised money. You're enjoying it for
Don't
a while.
To start paying back.
Yes. So the other terms are fairly basic.
Nice. Yeah. No. So, but see, conceptually, right? It's great to know that there's a product like this, and of course, we've seen that you guys also, when you were operating this, these companies have been growing, and obviously, it's a function of the overall VC landscape growing, more investments being made, and so on. So clearly there have also been successful returns in these cases.
Absolutely.
Right? So beyond another form of capital which makes up maybe 10 to 15%, 20% of the round, how does a founder see this as why this is useful for me versus, of course, taking more money from the same VC or even otherwise?
No, absolutely. I think Amit and I were talking that there are some softer reasons as to why people like to take venture debt along with a round, or think of that as an optimal capital mix apart from the financial reasons. Financially, it's a little bit of a no-brainer because you're not diluting for that additional capital. So, or let's just say it's extremely minimal dilution, a few decimals, if at all. And either you can use more money to generate more value and hence grow in number, or think of it as an insurance policy. When things don't go to plan, you have another source of capital you can fall back on. And hey, it's not as expensive as the equity. Definitely not as expensive as those interim bridges when they come together, because VCs take their pound of flesh for that. So one is that on the financial side. On the more qualitative side, I think we think of ourselves as another partner that you can onboard. So apart from the VCs, who of course have slightly more involved relationships, you can have different ideas about what the future growth plans should be like. And there are two decision makers on the table, not one. Even though a founder is super empowered, etc., if the views are quite divergent, it's going to start showing. in that time, you have another partner who is financially invested in your success, but at the same time is extremely objective. We're objective because we work with all the VCs in town. So it's not like we would side with one VC on your board versus the other. And we definitely are invested in the success of our own companies for our own financial returns. And we've seen that play out at scale. I mean, at least at InnoVen last, we had more than 100 companies in the portfolio. And the network gets super powerful. We have early stage companies looking to some of our late stage companies just for mentorship, advice, and a lot of business synergies as well. We are sector agnostic. And most venture debt shops are since the risk that you're taking is slightly different from actually materializing your own views. So my view that cryptocurrency doesn't work may not really flush out, because if there is a VC-backed cryptocurrency deal on the table, I might have to be flexible on my opinions, since I'm not as close to the action and my data might not be as primary as that of a VC. So it's slightly more derivative. And hence some of those network effects of onboarding a partner who is extremely relevant in the ecosystem and quite wedded to it can have its own perks.
Interesting. Wow. I think the whole point of also basically working on these financial models, I know I haven't gone through venture funding myself, so I'm not really done the math around this, but the founders who I know, and again in the same network, right, I think they definitely see a lot more value as another instrument of capital. And like you said, the neutral, the aspect that it's fundamentally neutral. And I think over the years, you guys have worked with, firsthand with almost all the leading startups of our many years now. So great. I think we're going to take a quick break and talk some more.
Hi, I'm Ambika.
I'm Hoshna. Over the last couple of years during our travels across India, we've had the privilege to meet and interact with a number of passionate people who are involved in preservation or conservation of a local heritage, art form or culture, or even environment and wildlife.
So in this season, we shine a light on some of these individuals and organizations and the work they are doing, many of whom are using travel as a means to give back to their communities.
By showcasing these wonderful people and bringing their work to a larger audience, it's our small way of aiding their effort and giving you an opportunity to be part of a unique travel experience. New episodes of the Rediscovery Podcast out every Monday on IVM Podcasts.
All right, welcome back. I think, we got a great understanding of what venture debt as a capital instrument is, and of course, how it has helped the startup scene here in India. I mean, even though it was a new product, and I think it still is, right? It's still not too many folks doing it. Obviously, banks haven't figured this out, like you said, but it's becoming more and more important as a cornerstone of the investing community for startups.
No, definitely. And we actually saw that tone change when a lot of our business started coming inbound. And this is founders picking up the phone and not really VCs making a call that it might be good to introduce venture debt in this portfolio company. Since we had those relationships, that was a huge channel for us. But a whole new segment opened up when founders really started themselves thinking about what are optimal capital mixes, partners that they would like to have on board. And I think the number right now would still be single digits of the entire VC market on how big venture debt is. Maybe in the US it's slightly early double digits, but we'll get there. I think there are more players coming in, more capital in this new form of asset class that's being invested by all domestic VCs, it's domestic LPs, etc. So the segment is only here to grow, I think.
Yeah, and also, what can you tell us about the unique viewpoint you had, right? You had venture capitalists as partners who you could question, who you could judge, who you could make your own analysis of. And likewise on the other side with startups, right? Typically, startups and startup founders don't get to choose their VCs, not many anyway. And I may have said on the show that we don't call enough VC folk here, but if I have, I would love to call some more VC folk here to pick their brains. But since you're here now, what were you able to gauge in terms of this unique relationship of how the other side, being able to see VCs from a different angle?
I think what was heartening to see is that more often than not, we did see that the investors and founders were on the same page. And if we've seen the show Silicon Valley, we're forced to think that that doesn't happen as often. But I think there's a lot of congeniality in the whole startup ecosystem, a lot of friendships out there. And I think those are the robust partnerships that have gone on to become really successful VC companies in India. That definitely has come from a certain pedigree of VCs that we have here. And I may be biased here, it's my personal view, but there is a benefit to having some kind of diversity in the firm that you're partnering with. I feel it's telling that if you have most of your GPs in a VC firm coming from a same kind of background or like experiences,
banking or finance or tech or
more like consulting. We don't see as many sort of banking finance folks there, but say consulting or people who've broken away from the same venture that they had started. We see some of those groups. I think it's a good sign if there's diversity around the table, because while one person champions the deal internally, a lot of the decisions get made in a more cohesive fashion. And at least, I mean, at our organization, we were we took that pretty seriously, and every decision gets debated and discussed, and that kind of transparency and openness in decision making is probably something that the VCs are better off if they implement in their investments as well. Having said that, the other thing is that at least for some of the top firms, there is now the second or third cycle that they're in. So people know them, they know the market pretty well. So if you're dealing with one of those, at least you know you're seeing the entire picture there is to see. There are a couple of new VC funds that have come in. So I think it all depends on what the entrepreneur is looking to see in the fund. Is it their experience that they're counting on, or is it just the capital? Right. On the experience front, I think the VC industry itself is quite young. I mean, there are the same kind of issues that we see in this industry in terms of diversity problems, gender diversity especially, backgrounds and all of that. And those things will evolve as the market evolves. But having said that, if you are in the good place of getting to choose which VC you're partnering with, I would go beyond the few basis points on the cap table and things like that. It's a long partnership. It's emotional in some ways.
Yeah, it's people after all.
Exactly.
Yeah. It's essentially people, although they're giving you lots of money. It's essentially on the back of, hey,
they're partners, right? I mean,
we're good, right?
No, but you got to work together, right? Forever, right? So I mean, like that is, it's tough to kind of make sure that you're right. You shouldn't make that decision based only on money, right? That decision has to be made like based on just how well you connect with that person and how kind of strong you feel about that.
And the same holds for venture debt as well. Even though these might be shorter relationships in some ways, slightly more time bound between the 3-4 year time frame, etc., it's still someone you're answerable to, and both parties need to be very comfortable discussing their businesses as many times as it takes, and their outlooks. And the stronger the relationship it is, it's just more enjoyable to work.
Absolutely. And again, that's basically what the overall startup ecosystem community, the vibe is what we talk about, right? Yeah. I mean, I know there are probably more fights between or competition between founders and other startups rather than in the VC community, right? I think pretty much everyone's sort of patting each other's back in like, oh yeah, you invested a few $100 million. Great, good for you.
Oh, you're really buying Twitter, aren't you?
But isn't that the case?
Really? I find that strange if that's true, right? Because I mean, like, the one thing that
I think all the VCs are always just golfing together or doing wine parties together. It's a good life.
It is a good life. I'm not saying it's not a good life, but the one complaint that I hear from all these guys who I meet, and I mean, like, maybe you can, is that there is the deal flow in India is fairly kind of not as good as what it would be elsewhere. And because of that, they're all very competitive to get their deals, right? So that kind of seems like an environment which would foster hostility and hyper competition.
Well, it's a business after all. I think that can't be wished away. So you're going to want the deals that you want, right. And if that means doing something that you wouldn't do with a friend in some way, inappropriate. So yeah, I think that part of the business will remain. One of the things I have felt though is it would be good if there was more open dialogue and discussions. Like I remember back in the day, I think A16Z put out a proper blog post as to why they were investing a 50 mil check in BuzzFeed. And that's a learning experience when you're actually starting to understand what goes on once you make a pitch, what goes on the back end. And maybe that's getting better with at least some meetups and mixers and here and there and VCs coming out on Twitter or talking more. But definitely a lot more insight into just how they go about things, being more vocal about their opinion, being more vocal about changing their opinion. I think we're in the business to remain to the pulse. We're not in the business of being correct about this going to work or not. Maybe the macros weren't stacked up rightly a few years ago and maybe they're now. So just being in the moment with your decisions and being vocal about it would just probably help the ecosystem even more.
Agreed.
Absolutely. I mean, it goes doubly for, of course, the startup community, but I think definitely in the investing community, because you guys are obviously doing a lot more research and a lot more focused thesis building across these various domains that you're operating in. And it can only help future founders or future companies and so on, right? So definitely a lot more work has to come out. But that being said, it's still looking, because the community is smaller, I think there's a lot more
tight-knit.
It's more tight-knit. And although we don't see too many deal partnerships between large VC firms, but venture debt, like you said, gets the advantage of basically having
we used to call ourselves Switzerland. We work with everybody.
And while, I mean, whatever piece of the pie you get across all startups. And in fact, I'd love to, before we wrap up, I want to hear about some unique, I would say, partnerships you were a part of, or the companies were parts of, which have really shaped the landscape of the scene in the last so many years. And how they actually came out. Like, what did you think of them when they were small and little and you were giving them a few crores, and then how did they end up?
So I think there are several of those in the portfolio. We've worked with some of the earliest e-commerce companies that made it big, worked with them several times over. So we've seen them at a Series B and then at a Series C, because the logic of venture debt tends to work at every round. You're still saving dilution. You're still taking your insurance policy.
Right.
And if it's a partnership that both like and see benefit in, it's going to remain. So I think we've been lucky to work with some of the really big companies in the ecosystem. The other thing, of course, is that these include unicorns, and that's a space probably that the team made an effort to build out, to find use cases on why would someone need alternative financing if they're raising hundreds of millions of dollars. And that is where maybe some of the financial proficiency helps, where you're trying to think in terms of returns on investment and internal rate of returns. And for example, if it's a capital intensive business, you're going to keep needing capital, and to take on equity for every single one of those uses may not be the most optimum use of that expensive form. So you're trying to marry that to why you're actually raising the financing. In some companies, what's worked is just the fact that they want to propel their growth rates. For example, a TV advertisement. A startup, for them, it's not as easy as one of those large companies to get those slots to make an ad that works, and it's a huge investment. You're doing a mass campaign, which means probably that you're a pan-India brand, and those kind of things tend to cost money. And for those use cases, would it help to take a lower cost financing option? In most cases, it does. Yeah. So I think in summary, the way it is, if you want to pack a punch in a limited period of time, you want as much capital as you can. You need that fuel in the tank to really start investing in all the experiments that you think can bear fruits, because we all know in the VC and tech business, it's disproportionate.
Yeah.
The VC-able businesses are those which do not have a linear growth or return logic to it or anything. And that means every rupee invested could really generate huge amounts of returns. Right. And some of the the exits that we saw in the market are exits that we've seen in the portfolio as well. Like Myntra, Flipkart is super well known. There's Freecharge and Snapdeal, and those outcomes and having a ringside view to them and how those businesses have shaped up has validated the model in so many ways that entrepreneurs after that look at those examples and tend to think that if it made sense for them, we have similar aspirations. So I think we're definitely at a point where you wouldn't brush off venture debt thinking that, okay, we don't want that risk or we don't want that headache or obligation. You're really starting to evaluate whether it makes sense for different use cases. And I think that is also the job of the team to really find how these companies could start using these forms of capital. And the team plays such a big role in that.
Right.
You need a similar kind of personality to understand what goes with the business or doesn't, just as a VC partner would. And that's what makes it a more equitable relationship. You're having similar conversations. The DNA is extremely similar.
Right.
Wow. So, I mean, obviously you guys have invested across sectors, and while you will now go on to build maybe something really cool and interesting, what do you think these guys are going to invest in now? The latest hot sectors are what? Lending itself and crypto. So what's your take? I mean, now you can say this because you're not with InnoVen. What's your take? Would you put venture debt into companies who are growing in these crazy domains?
Tricky.
Can they really take money from you as a loan and then give it out again? Is that even structurally possible? I'm sure it is.
So on-lending is a fairly understood concept. A lot of the new age lending businesses themselves, their balance sheets are made of two forms of capital.
Yeah.
So our organizations have worked with those companies in the past, and that always makes sense because when you're a lending business, some of your capital, easily put, is just parked away for safety. Mm-hmm. And why would you take such expensive capital to park away for safety? So that's when the debt starts making sense for finance businesses. But it's not finance that's caught my attention for what's next for me.
Not crypto either.
Not crypto either. I may have lost a lot of money also.
No, I see.
I have burnt my hands.
No.
It will come back again, is what I tell myself.
That's not a good investment thesis.
At least I'm honest to tell I don't understand. Sign of a good VC.
Yes.
No, actually, what's sort of I found myself catching the bug from working with such passionate people around me, and like I was telling Amit, I found a problem I couldn't stop thinking about, and it's just a sign I had seen so many times over at work that I knew it was time. It's actually the healthcare space which has caught my eye. We were talking on just how broken it is, and in my thinking of it more dispassionately, and a lot of people who pursue healthcare do it out of personal motivations. They went through an experience that was definitely not ideal and possibly more hurtful than it had to be, and some of those motivations then get sort of transform into the passion that you need to solve a problem that's not only tough, it's also emotionally taxing. You're dealing with actual lives here. It's not a late delivery or anything. You're trying to do something that's slightly more impactful. Mm-hmm. And to that extent, what I saw from personal experiences was a space that touched many lives. I think after fintech, transportation, horizontal e-commerce, food, healthcare is something that touches almost everybody's lives. Yeah. And the amount of innovation we see in that space in India is barely scratching the surface. Yeah. Barely. And in fact, even the models that we see, right? I think we're still talking about doing healthcare records online. We're talking about telehealth, and
there's so much to be fixed.
And some of those problems. And I'm optimistic. I mean, there are companies that are using AI and computer imaging to start getting into sort of more IP-driven technologies, and it's heartening to see that that's coming on the curve as well. But it's still a long way to go. And this is a space that needs so much infrastructural support. For example, healthcare records. If you're a company that's working on healthcare and if you're making it pervasive across your systems, there's not only the policy issue of safety, security, and permissions. It's also that can you make it a universal language where all hospitals talk to each other? Yeah. And information is just one piece of it, because information alone may not be as monetizable. That's always been the problem with information across some of the other industries as well. You need engagement. You need something of value that you're giving and taking. And I believe India is probably at a point where our biggest problem is data sets. Unlike the US, where you have an insurance-backed system and all the records are at least in a language and in a system that's more pervasive. In India, since there is a lack of data set, it's tough to organize anything. It's tough to know the actual extent of the problem. And the ideal state scenario, for example, is if you have enough data, as it's proven in other industries, you can actually start thinking about diagnosis. You can do predictive analysis on how a person's 60s will be or 70s will be. You can actually start getting so much more useful data when you're doing your clinical trials and figuring what your demography is like. I think information and communication to solve that in healthcare is probably something I'm just re-educating myself in. Nice. Not an expert by any stretch of imagination, but it just seems large and stark.
No, I'm sure it's going to be awesome, and we are looking forward to having you back when you have some startup to announce. So I'm really excited. That'll be fun,
actually. We should definitely.
I'm really excited.
You could be our first second guest, or first duplicate guest.
Yes.
Yeah.
All right. I mean, this was a great chat.
Yeah, no, exactly. I learned a lot about this stuff, man.
Yep. All right. So, Suhani, where can folks get in touch with you on Twitter? How do they reach you?
I am on Twitter at Suhani1911. Yeah, @Suhani1911. That's me.
Okay.
Awesome. My email is the same @gmail.com. So awesome. I'm your. Yeah.
Awesome. Let's hope. And you should also join our Slack channel.
Yes, you should. Yes. You know how you do? Do you know how you join the Slack channel? You join the Slack channel by going to the website ivmpodcast.com/Shunya One. Over there, there's a button which says join the Slack channel. You click that button, send us your email address, and you can join the Slack channel.
Yes.
Also, we want reviews. We want lots and lots and lots of reviews. Please send us reviews on iTunes and wherever else you listen to the podcast. Just put a review up. Say you like the show.
Awesome.
Yeah, the reviews are only meant for Shiladitya and Amit in the show. Yes.
Oh, no. But thanks so much for doing this. This was awesome.
It was great.
And it was great having you on the show. And we're looking forward to what's next. And of course, if anyone wants venture debt advice, Suhani is the person to ask.
I can consult.
Yes.
Thanks so much for having me. It was great talking to you guys.
Thanks.
There she stands, a podcast addict. Outside the bank, having traveled several miles to get in with other poor souls like her. The journey, though daunting for this youngling, will have some comfort because she has downloaded her favorite podcast. You can see more of her species on ivmpodcasts.com. Your one-stop destination where you can check out the coolest Indian podcasts. Happy listening.